Hello. With the end of the year being so near, I always enjoy kind of going over different tax planning opportunities. And one of the biggest opportunities available to most is going to be the opportunity to do Roth conversions. And what a Roth conversion is when you basically decide to move money from a traditional deferred tax account, like a traditional IRA or traditional 401k, if your employer allows it, and move those funds into a Roth account. Basically, when you do that, you're deciding to recognize the income taxes for that given year that you do the conversion. But the nice thing about that, you'd be like, why would I ever want to pay more in taxes than I need to? But the other side of that is once it gets into that Roth account, you may never have to pay taxes on that again, which is a really, really good opportunity. And I'll go over a few of the details in this quick presentation as to the different things you should weigh as far as pros and cons there. With that, I think that one of the biggest indicators of whether or not you may want to consider Roth conversions is where you feel future tax brackets may end up falling. Interestingly enough, with the recent tax reform that was passed at the end of 2017, tax rates actually went down. Taxes that people are paying are going to be lower for the next couple of years. But what are those going to look like as the current tax law is phased out and kind of new politics come into play? Are those going to be higher in the future? If you do believe that that is the case, it may be a strong reason to start to think about Roth conversions now while we may be in a lower income tax bracket kind of few years. Another important opportunity that I feel a lot of people don't recognize and take advantage of, and it ends up costing them thousands and thousands of dollars as far as future tax implications. So if you had a really unique income year, maybe you were laid off, maybe you stayed at home while you were having children. If your income has fluctuated to a lower amount than what you're used to, that could be a great opportunity to recognize some income while you're in a lower tax bracket. And then obviously this is a year by year decision. So just because you decide that you want to do Roth conversions this year doesn't mean that you have to do it every single year. And you can determine how much you want to do. So I mentioned you can move funds for your traditional IRA or 401k over to a Roth account. You don't have to do the full balance, and it's usually not in your best interests to do the full balance. You want to do it in bits and pieces that kind of fill that tax bracket that you're in. But if you had a unique income tax year, that's definitely a good opportunity to at least consider a Roth conversion. What do you feel that your future income is going to look like? For many in their 20s and maybe early 30s, there's a high probability that your income is going to be higher in the future. And so there's going to be no better time than you to take advantage of Roth accounts, whether it be direct Roth contributions or Roth conversions, than early in your career. And that's because as your income rises, so will your tax consequences. And so you'll definitely want to do that when you're in those lower brackets and it's not as big of an impact. But yeah, again, great opportunity to save thousands of dollars potentially in future growth in the account, and then being able to withdraw those tax-free and avoid that tax situation. Be aware of the impact. So there's more things to consider when you're thinking about you're doing a Roth conversion. So it's not just the tax impact on your ordinary income tax bracket. There's a few other things that it bleeds into and may impact. So you definitely want to make sure that none of these apply and research your full situation, because there are a few things that I wasn't able to squeeze into the slide, but just a few of the things off the top of my head were financial aid for school. Recognizing more income in a year is definitely going to impact that. So you definitely want to maybe consider delaying a Roth conversion or something like that if that's the case. If you currently are kind of on the market for the market plans for health insurance, if you're receiving subsidies, increasing your income may reduce that possibility of getting those subsidies. So be aware of that. There's different tax credits and tax deductions that you may be eligible for that are impacted by how high your income is. So you want to make sure that you avoid phasing yourself out of those credits and deductions. If you're in that retirement stage of life, your Social Security is actually taxable. And if your income increases, that may increase how much of your Social Security may be taxed. So that's important. And then lastly, capital gains. There's a certain threshold where you may not be paying any tax capital gains at all. But once you surpass that threshold, whether it's for any reason actually, you just want to make sure that you're not making a tax mistake there and costing yourself more than what you expected just from that income recognition from the Roth conversion. Another interesting thing, especially as it applies towards the recent tax reform that was passed last year, is in the past you used to be able to do as much Roth conversions as you wanted to, and then if you realize that you made a mistake, maybe you knocked yourself out or phased yourself out of one of those situations that I mentioned on the previous slide, and you're like, oh, let's fix that. You could actually reverse that in the following year while you're doing your taxes. But with the new tax reform, they said no do-overs there. So you do want to be precise. You want to make sure that you're checking into all these things ahead of time, because there's not going to be a do-over for you if you make a mistake when it comes to that Roth conversion. Conversions versus contributions. So contributions to Roth accounts are very unique and very popular just in their own right, because any contributions you make towards the Roth account, if they're eligible contributions, you can actually take those out at any time. You can take them out the next day if you wanted to. The thing is, you can't take out more than what you put in, and that's just a unique feature of Roth accounts, is those contributions, you can take them out without any penalty or tax considerations. But if you do a Roth conversion, that's where things differ pretty substantially. It has its own 5-year rule, and it's kind of tracked separately than your Roth contributions. So make sure that you avoid getting confused with that. You can't take out the funds that you converted over into the Roth account like you could contributions into the Roth account. There'll definitely be penalties in that situation. Luckily, there's a 5-year waiting period. If you wait that long, then you would be eligible to start taking some of those conversions out if you needed them for another expense. And so lastly, just in conclusion, I think I mentioned this earlier, but it's a year-by-year choice. You don't have to do it every single year, and especially with the no do-over factor, you want to wait until about November or December to make sure there's not going to be any tax surprises, any significant bonuses that would pass you over certain things as far as those phase outs and thresholds on deductions and credits. But basically, you can decide that every single year. Make sure that you plan ahead and use that precision to make sure that there's no surprises. And again, this is just a really unique, powerful opportunity. And by not doing it, if it would be something that would benefit your situation, it's going to cost you thousands and thousands of dollars. So pretty dramatic impact as far as just making the most of the assets and all the hard work that you're doing today. And so hopefully that's helpful for you. Feel free to reach out if you need one-on-one assistance, but enjoy the rest of 2018, and I'll be talking to you again soon.